So good evening. Today we have to start the lesson from the pre-money valuation and post-money valuation. So these two concepts, the pre-money valuation and post-money valuation, it comes to it is important when new investor wants to join to the venture at the middle of the business. Then we want to know the pre-money value and the post-money value of the business. So in simple, this pre-money valuation means what is the value of the business before any new investment is injected to the business. Yeah. So pre-money valuation is simply what is the value of the business before any new investor join into the venture. Right? So post-money value is the pre-money valuation plus the new investment. So these two concepts come into the place when someone wants to join to the venture at the midway. Right. So I will explain these two concepts with the calculation. Right. If we take this example, I am referring to the earlier example. So last week we have calculated the value of the venture for Kasun, and now an outside investor wants to invest 100,000 rupees in Kasun's restaurant. Now that means at the end of year 0. So we have calculated the value of the venture at year 0. You'll remember. So I will share the Excel sheet with you all. So this is the last part of the previous question that we have discussed last week, right? So we have derived the value of the business as 550,443. So now this value is called pre-money value. This is pre-money value. This is the value of the business without any equity injection by another investor. Right? And post-money value is the value of the business right after the new investment. So post-money value will be equal to this 550,000 plus the new equity investment value, which is 100,000. Right? So it will be equal to 150,443. So what is the value of the business before the new investment will be pre-money value. The value of the business right after the equity investment will be the post-money value. Right? Then the part 5 of the question, what is the percentage of ownership in the venture? What is the percentage of ownership in the venture should Kasun give up to the outside investor for the new investment? So before this new investment, 100% of the venture is owned by Kasun. Right? So when someone else wants to join to your venture, you have to give part of your ownership to someone else. So how do we calculate this percentage of ownership? The percentage of ownership. The percentage of ownership we can calculate by simply dividing the new investment value by this post-money value. The ownership percentage can be calculated by dividing the new equity investment value divided by the post-money value. So just tell me through the chat what is the percentage of ownership that Kasun should give to the new investor. The new equity investment value is 100,000 and should be divided by the post-money value, yes, which is 15.37%. So new equity investment value is 100,000. It should be divided by the post-money value, which is 150,000. So as a percentage, this would be equal to 15.37%. Right. So I hope you all have understood how to calculate the pre-money value and the post-money value. Just calculate the value of the business right before the new equity investment, that is called pre-money value. Right? And then we add the new equity, the investment value, to the pre-money value. That value is called the post-money value. Right. So moving on to the next question. Right. So question number 3. So first take 2 minutes and read through the question. And this is an example for using different discounting factors to reflect the different risks in life cycle stages of the venture. So first read the question. So Kumara, owner of the Sicily Gardening, wants to determine the present value of his investment. The Sicily Gardening is currently in the development stage but hopes to start the operations at the end of the next year. So after-tax cash flows during the next 5 years are expected to be as follows. So cash flows, the positive net cash flow will be generated at the end of year 4, year 5, and then cash flows are expected to be 350,000 in year 6, and thereafter it will grow at an annual rate of 9%. The target discount rates by the life cycle stages are given. At the development stage, the discounting factor is 40%. At startup stage, it is 35%. And at survival stage, it is 30%. Early rapid growth stage, 25%. And at maturity, it is 15%. Right? So as I have told you earlier, so it reflects the risk in the business. So at the very uh, early stages like development stage, there is a high risk in the venture. So therefore investors will require a higher return. So with the time, when the venture move on to the latter part of the life cycle, then the discounting factor will decrease because the risk of the venture will also decrease. Right? So this question is example so we have to use the different discounting rates to get the present value of these cash flows. Right? So how do we calculate the value? So the first question is determine the terminal value. Then the second question is what is the present value of this venture? And then you have to calculate the percentage ownership. Right. So if we draw a timeline, take if we draw a timeline like this, right? So year 1, 2, 3, 4, 5, and 6. So the cash flows, the first positive cash flow will occur at year 3, end of the year 4, which is 250,000. So now we have to determine which stages are reflected throughout this timeline. So it is clearly stated in the question that currently the venture is in development stage. So that means year 0 to 1, the venture is in the development stage. Right? Here, venture is at development stage. Development stage, and it is given that venture hopes to start their operations at the end of the next year. Right? So that means this period should be equal to the startup stage. This period should be equal to startup stage. Right. And then the first positive cash flow occurs at the end of the year 4. Right? So normally at which stage venture generates positive cash flows? At which stage? At which stage normally venture would generate a positive cash flow? So now you can't remember the stages of life cycle. Right? What is the stage that venture would generate a positive cash flow? So tell me the answer through chat. What is the stage? Normally, the cash flows will be generated even at survival stage. But normally the positive cash flows, that means the cash inflow should exceed the cash outflow. So the positive cash flows will be generated normally at the early growth stages. So therefore we can assume that here from year 4 to year 6, it will be the growth stage, right? So that means here from these 3 years will can be considered as early growth stage. Then in the question, he stated that after year 6, the cash flows will grow at 9% at a constant rate. So we can assume after 6th year, it will be the maturity stage of the business. So hereafter, this will be the maturity stage. So therefore, we can assume that year 2 to 3 is our which stage? The survival stage. This is our survival stage. So now you know what are the applicable discounting factors to each stage. So if it is development stage, what is the applicable interest rate? If it is development stage, applicable the discounting factor would be 40%. And if it is startup stage, it would be 35%. Startup stage, it would be 35%. And for survival stage, it would be 30%. And for growth stage, it would be 25%. And for maturity stage, it would be 15%. And growth rate during this period would be equal to 9%. Right? Growth rate during this period will be equal to 9%. And at the end of year 4, the cash flow is 250,000. At year 5, cash flow is equal to 300,000. And at the end of year 6, cash flow is equal to 350,000. Right. So now can you all take like 5 minutes and calculate the present value of this venture? Right. So first part of the question is calculate the terminal value. Right. How do we calculate the terminal value? How do we calculate the terminal value? How do we calculate the terminal value? We get the cash flow at the year 7, which is the stepping stone year. Right? So here we have 350,000. So we add the growth rate of 9%. Right? So here, how do we calculate the terminal value? We take this 350,000 cash flow and apply growth rate of 9%. So 1 plus 9%. And this entire term should be divided by, so this is a growing perpetuity, right? So hereafter, starting from year 7, so cash flows will continuously grow at a stable rate of 9%, right? So it is a growing perpetuity. So how do we calculate the present value of growing perpetuity? We take the cash flow and then we divided it by required rate of return minus the growth rate, right? So our required rate of return at the maturity stage is equal to 15%. So 15% minus the growth rate is equal to 9%. So tell me, what is the terminal value? Yes, you can give me the answer. Yes. So the terminal value is equal to 6,300,000 58,333. Right? 6,358,333. Right. So what we do is we take the cash flows at the first year of the implicit period. So you all might have remember this 0 to 6 means the explicit period. So beyond this 6 year is called the implicit period. So we can take what is the value of the cash flow first year of the implicit period, which we called as the stepping stone year. Cash flow at the stepping stone year divided by the required rate of return minus the growth rate, which gives you the terminal value. Right. So now take 5 minutes and calculate the value, the present value of this venture, Cecilia Gardening. So how do we calculate the value of this venture? So the first cash flow occurs at the end of the year 4. So what is the value of the cash flow? 250,000. Right? So cash flows occurs at the end of the year 4. So year 4 to 3, what is the applicable? So that means year 4 is, it represents the growth stage, right? Year 4 to year 3, it represents the growth stage. So what is the applicable interest rate? The discounting factor, it would be 25%, right? it would be 25%. So we have to discount this cash flow by 1 plus 25% for 1 year, right? And then you have to discount the cash flow again using a different rate, because now we are at the survival stage. So the applicable discounting factor to survival stage is 30%. So you, in order to get the present value of the cash flow, then again we have to multiply it by 1 plus 30%. So now the present value of cash flow is at the end of the second year. So to get the present value at the end of the first year, you have to discount this by 35%. So 1 plus 35%. Again, to calculate the value at year 0, you have to discount it by 40%. Right? So now you can do the rest of the calculation. So if we take the next cash flow, that would be $300,000. Right? So this 300,000 cash flow occurs at the end of year 5. Right? So there are 2 years in development stage. So you have to discount by 25% for 2 years, not for 1 year. You have to discount this by 2 years. Right? And again, to take the value at the end of the second year, you have to discount it by 30%. To get the value at the end of first year, you have to discount it by 35%. And to get the value at year 0, you have to discount it by 40%. Right. So if we take the cash flow at year 6, so at year 6 we have a cash flow of 350,000 plus the terminal value, which we have already calculated. So the terminal value is also comes at the end of year 6. Right? So the terminal value here is equal to 6,358,333. Right. So now the summation of these two cash flows, right, are at the end of year 6. So that means you have to discount these cash flows by the discounting factor of 25% for 3 years. Right? Then again for 1 year, 30%, and to get the value at the end of second year, you have to discount it by 35%, and then to get the value year 0, you have to calculate the discount these cash flows by 40%. Right. So do the calculation and tell me what is the value of this business? So others also get the same value, 1,557,445. So others also come up with the same value. You're clear with this calculation. So you have to apply different discounting factors when you get the present value, because each of these years reflect different life cycle stages of the venture. Right, this answer is correct. The value of the business is equal to 1,557,447. Right. And then the next part of the question is, what is the percentage of ownership in the venture should cousin give up to the outside owner for the new investment? So now you know how to calculate the ownership percentage. So do the calculation and tell me what is the percentage of ownership. So how do we calculate the percentage of ownership? How do we calculate the percentage of ownership? We take the new equity investment and divide it by the post money value. Yes. So this 1,557,447 is the pre-money value, right? The value of the business without adding any new equity investment, right? So this value is called the pre-money value. So how do we calculate the post-money value? You have to add the new equity investment to this value, right? So here in this example, the new investor, the Aloka, and is willing to give 500,000. So here he is willing to give 500,000 new equity investment, right? And our pre-money value is 1,557,447 plus, to get the post money value we have to add the new equity investment as well. So 500,000. Which is equal to, so as a percentage, this would be equal to 24.3%. Right. So I hope up to now you all are clear with these calculations. So moving on to the so next concept, you all know this concept, the equity valuation cash flow. How do we estimate the free cash flow to equity holders? Free cash flow to equity holders. So free cash flow to equity holders mean what is the residual amount of cash flows available for the equity providers of the venture after meeting all the financial obligations. So free cash flow to the equity means the residual cash flow available for the equity providers after meeting all financial obligations. So in free cash flow to the equity, we are considering the leverage impact to the cash flows. So we can calculate the equity cash flow to the business by starting from the net income. We have to add all the non-cash charges. So normally the depreciation and amortization are the major non-cash charges of the business. Then we decrease any increase in net operating working capital. Here we do not consider any surplus cash. And then we deduct any increase in capital expenditures. Right? Here the increase in working capital and increase in capital expenditures should be deducted. And then we add the net borrowing, the net debt issues. So what is net borrowing? So if we have borrowed a new debt, that is considered as a cash inflow to the business. If we have borrowed some amount, that is considered as cash inflow, and if we have payback these, we have repay the debt, that is considered as cash outflow. So repayment of any loan or debt is considered as cash outflow, and issue of new debt is considered as cash inflow. So this net debt value is equal to the newly issued debt minus the repayment of the previous debt. Right? New debt minus the previous debt is called the net debt value. Right. So I hope you all have remembered this calculation. So can you all attempt on the practice question, the first practice question? Right, just go through these values. And the first requirement is assume that cash account includes only required cash. So that means this 50,000 and 60,000, there are no surplus cash included in this value. All this cash amount reflects the required cash. And determine the amount of equity value cash flow for 2020. Right. So now you know how to calculate the equity value cash flow. We take the net income and add non-cash charges, normally the depreciation or amortization value, and then we deduct any capital expenditure increases and the net working capital increases, and then we add back any net borrowing amount. So I will give you 5 minutes. Just attempt on the question. Right. So I have copied down all the relevant information. Here we have the financial statements, the income statement, and the balance sheet value. So the first part of the question is calculate the equity valuation cash flow considering all this cash account represents the required cash. So how do we calculate the equity cash flow? Starting from the net income. We start from the net income. We add any non-cash charges value and we deduct any increase in operating working capital and deduct increase in capital expenditure. And then we add the net borrowing amount. To come to the free cash flow available to equity holders. Right? So now we are calculating the free cash flow of the equity holders for year 2020. Right? So net income is equal to 132,000. And then the next calculation is increase in working capital. Right. So how do we calculate working capital? How do we calculate the working capital? We take the difference between current assets and current liabilities. Right. So if we take 2019 and 2020 values, so we have three current assets, cash, accounts receivable, and inventory. And two current liabilities, operating current liabilities, accounts payables, and accruals. So we don't consider bank loans as operating liability. So cash, receivables, and inventory. So we take the difference between these two. So the total current asset value is equal to and total current liability is equal to so thereby you can get the working capital. So total current assets minus total current liability. But what we want is not the working capital, what we want is change. So from 2020 value, we deduct 2019 working capital value. So the difference is 160,000. So this is an increase in working capital. So we have to deduct. And non-cash charges, of course, equals to depreciation value of 2020, which is 55,000. And then you have to calculate the increase in capital expenditures, increase in capex. So how do we calculate the increase in capital expenditure? Here we take the difference of the fixed assets, but should be careful. You have to take the difference of fixed asset, the gross values, not the net values. Here net values means after subtracting the depreciation value. But you have to get the change in gross fixed assets to determine the increase in capital expenditures. So if we take these two values, so now we are attempting to calculate the increase in capital expenditure. Right? So this is net fixed assets. To get the gross fixed asset, you have to add what? The depreciation, the accumulated depreciation values. So for 2019, what is the depreciation value? In the income statement, the depreciation value is equal to 40,000, and the accumulated depreciation for 2020 will be equal to 40,000 plus this 55,000. So now you can calculate the gross fixed asset value. Gross fixed asset value. It is 340,000 and 475,000. Right? Now again we are looking for the change. So 475,000 minus 340,000. So the change in capital expenditure is equal to 135,000. So equal 135,000. So the next working is net borrowing amount. Determining the net borrowing amount. Determine the net borrowing amount. So here we are taking both the short term and the long term borrowing. Short term and long term borrowing. So in 2019, there is a long term debt of 400,000 plus the bank loan of 80,000. In 2019 also, this venture has a long-term debt of 550,000 plus the bank loan of 90,000. Here also we take the change. Equal 160,000 minus 400,000, it is equal to 160,000. Now we can calculate the free cash flow to the equity. Right? Net income, we add the non-cash charges, then we deduct increase in working capital and increase in capital expenditure, and then we add the net borrowing. So the free cash flow to the equity is equal to 52,000. Right. So next part of the question is, now assume that the global products required cash is set at 3% of sales. Any additional cash would be surplus cash. Re-estimate the amount of equity value cash flow for 2020. Right. So earlier assumption is all these 50,000 and 60,000 of cash represents the required cash. There are no any excess cash amount. So now they have given the required cash amount is equal to 3% of sales value. So let's calculate the required cash. The required cash amount for 2019 is should be equal to net sales into 0.3%. This is for 2019. For 2020, required cash should be equal to 1.6 million into 3%. It is 48,000. So now the cash amount, the company has cash amount of 50,000 and 60,000. So you can calculate the excess cash value. So out of this 50,000, 11,000 is excess cash. So when we are estimating the equity valuation here, the only difference would be, there should be difference in the working capital calculation, right? Because in working capital calculation earlier, we considered it as all the cash or required cash. We considered all the cash in the balance sheet is equal to the required cash amount. Yes. So normally in valuation, earlier in the company valuation, we do not consider the cash value when we are estimating the working capital. But in ventures, we consider only the required cash. Only the required cash when we are estimating the cash flows, especially the working capital. Because the cash is important operating item for venture. So now we can recalculate the working capital amount. So if we take these values here, the only difference would be here. We should only take the required cash amount. So now the change in working capital is equal to 159,000. So we can recalculate same thing. Only difference here would be instead of 160,000, now it is equal to 159,000. So free cash flow to the equity amount is equal to now 52,000. So rest of the questions are easy. So the third part of the question is, let's assume that investors in global products wants to estimate ventures present value at the end of year 2019. Forecasted financial statement reflect the stepping stone year. So that means this year 2020 is the stepping stone year. And cash flows are expected to grow at a perpetual rate of 8% beginning in 2021. Assume that all cash is required cash as was done in part 1, and if the annual required rate of return is 25%, what would be the value of the business? Here, so growth rate is 8%, discounting factor is 25%. According to the scenario of the first part of the question, so free cash flow to the equity holders at the stepping stone year is equal to 52,000. This should be divided by required rate of return minus the growth rate. This would be the value of the venture at the end of year 2019. And the fourth part, of the question, work with the assumption in part 2 about the global products required cash being 3% of the sales. Calculate the present value of the global products venture at the end of year 2019 if investors want an annual rate of return of 25% and the growth rate is also 8%. The only difference is here we are taking the assumption that there are excess cash in the venture. So according to that assumption, the free cash flow available to the equity holders is equal to 52,000. This should be divided by the discounting factor 25,000 minus the 8%. So according to here, this value should be equal to 53,000, right? Add non-cash charges and deduct the increase in working capital and capex, and then again add back the net borrowing. Okay. Free cash flow to the equity amount at the second scenario should be equal to 53,000. So here again the value of the business according to the second scenario is equal to 311,764.71. This is according to the second scenario where the venture has excess cash. The value of the venture, if the venture does not have any excess cash, is 305,882.35. Right. So now shall we move on to the next question? The mini case. Here also for this soft tech products company, which is a successful small rapidly growing corporation, and you have given the current year the financial statement values, which is 2016, and the projected income statement for the next 4 years. That means from 2017 to 2020. And net sales are expected to grow at an annual rate of 7% starting from year 2021. So that means year 2021 is the stepping stone year according to this question. Right? So if we look into this question, we have given the actual values of the income statement for 2016 and the projected income statement from 2017 to 2020. And some selected items from the balance sheet is also given: net fixed assets, the summation of required cash, accounts receivable and the inventories, accounts payable and accruals. So these values are required to calculate the change in the working capital. So each of these balance sheet amounts was expected to grow with sales. So all these balance sheet items will be growing in line with the sales. So no changes in interest bearing debt and no plans to issue any common stock. And there are currently 10,000 shares of common stocks are outstanding in the company, the venture. And the applicable common equity, the required rate is 25%. So the first part of the question is to project the income statement for 2021. Project the income statement for 2021. So you can quickly do that, right? The forecasting the income statement for 2021. Right. So in order to forecast the cash flows of the financial statement of the 2021, the income statement, you can use the percent of sales method. Here you will have given the expected growth rate of sales. So simply you can calculate the growth rate, the value of sales for 2021. So 2020 sales value into 1 plus sales growth rate, which is 7%. Right? Then you can calculate the percentage of these expenses at the cost of goods sold, admin expenses, depreciation, EBIT as a percentage of net sales. Right? From the earlier years, actually we can take from this 2016 values, using this 2016 values. So hear me? So you can see the can you see the Excel sheet? For a moment, I think we lost the connection. Right. So earlier you all didn't hear anything. Right. So the explanation for this question was not clear to you all, right? You all didn't hear that part. Right. So I was talking about, So we have given the actual values of the income statement and the projected values of the income statement for another 4 years. So what we have to do is, the first part of the question, the requirement is to project the income statement for year 2021. Right? For that, we can use the percent of sales method. So we have already given the expected growth rate of sales is 7%. So straight away we can calculate what is the value of sales for applicable to 2021. Right? So we take the previous year sales value 1 plus the expected growth. Right? And then we can calculate the other components of the income statement as a percentage of sales. Right? So that is what we do in percent of sales method. So you'll have learned this in the forecasting financial statements lesson. Right? So we take the value of cost of goods sold as a percentage of sales. So that would be 50%. So likewise, we can calculate what up to EBIT, because interest will not change with the net sales. Tax also not change. So therefore, these values will change according to the changes in net sales, accordance with the changes in the net sales. So now we can calculate the values for the other items of the income statement. Here, so the cost of goods sold is equal to 187.3 rupees, and administration expenses 74.9, depreciation 18.7, and EBIT 93.6. Right. So accordingly, the EBIT value will be from the gross profit. You have to deduct all this. The interest cost will not change. So because in the question it is clearly mentioned that they are not going to issue any no changes in the interest bearing debt. So there will be no change in interest cost. So interest cost will be fixed at 3.5. So EBIT we can calculate EBIT minus the interest rate. So earnings before tax would be equal to 90.1, and the tax we can calculate here 90. The applicable tax rate is given as 40%. So 36.1 would be the tax amount. So net income is equal to 90.1 divided by the minus 36.1, which is 54. Not exactly. Right. So the first part is done. The second part, determine the annual increase in required net working capital and capital expenditure for the Softtech for year 2017 to 2021. Right. So now we have to calculate the second part of the question is to calculate the working capital. Required net working capital and the capex. Let's first calculate the working capital amount. For 2016, the balance sheet items are given, right? Required cash, receivables, accounts receivables, inventory is equal to 50, right? So the current assets in year 2016 equal to 50, current liabilities equal to 25, right? Accounts payables and the accruals value here. So now we have to determine the values of current assets and current liabilities for 2017 to 2020. Right. For that, there is a hint given where all these balance sheet items was also expected to grow with the sales. So now we have to find the growth rate of sales growth rate for these years. For that, you have to take the difference between 2017 and 2016, divide this by the 2016 sales value. You have to take the value for 2021 as well. So minus 374.5 minus 350 divided by the previous year's sales value 357%, which is also given the expected growth rate. So now we can calculate the current assets and current liabilities values. Into 1 plus growth rate. So that we can take the difference between current assets and the forecasted current assets and current liabilities. That would be equal to the net working capital amount. So current assets minus current liabilities. Right. Now what we need is the increase, right? Increase in required net working capital. Therefore, we have to take the change in these values. Minus 25. Likewise, you can take the change. And the next part is to determine the capital expenditure value. Again, the capex value. So how do we determine the capex? Capex is equal to change in gross fixed assets. So here also you will have given net fixed asset value, right? So the net fixed assets in year 2016 is equal to 50. Right? This values is equal to, this is net fixed asset value. So we can calculate the increase in net fixed asset value by applying the sales growth rate. As in the question, because it tells that all these items will grow aligning with the sales. So that is why we are applying this sales growth rate to these values. Right? So in order to convert to gross values, you have to add the accumulated depreciation. You have to add the accumulated depreciation. So according to the financial statements, 2016 depreciation is equal to 7.5. So accumulated depreciation will be equal to, in 2017 will be equal to this 7.5 plus the new depreciation value, which is 10. Right, now we can calculate the gross fixed asset value. Right, gross fixed asset value. Now you can get the change of the gross fixed asset value to determine the capital expenditure. So 84.17 minus 57.5 will be equal to the capital expenditure, change in capital expenditure value. So answer for the second part of the question is that I determine the annual increases in required working capital and the capital expenditure starting from 2017 to 2021. Right. And then project the annual operating free cash flow for the years 2017 to 2021. So now the next part is projecting the annual free cash flow. So part 3 is projecting the annual free cash flow. So how do we calculate the free cash flow? Starting from net income. Again, you have to add non-cash charges, deduct increase in working capital, and any increase in capex. And here, since we don't have any changes in net debt value, there will be no adjustments for net borrowing. Right? So now all these values we have already calculated from 2017 to 2021. So net income, you can calculate, and non-cash charges is equal to depreciation value. So again the depreciation values. calculate and get the depreciation values. An increase in working capital and increase in capital expenditure we have calculated in the previous part of the question. An increase in capital expenditures also we have calculated. Now we can calculate free cash flow to the equity holders by adding the non-cash charges to net income and deduct both the increases in working capital and the capital expenditures from that value. All right, here. So free cash flow to the equity holders starting from 2017 to 2019 is equal to these values. 2.9 for 2017, 10.4 for 2018, 17.9 for 2019, for 2020, 25.4 and for 2021, 41.8. So this is part 3 of the question, projecting the annual operating free cash flow. Same this as operating free cash flow. Right. Then the fourth part, estimate the terminal value cash flow at the end of 2020. Right. So now we have to calculate the terminal value. Terminal value. So terminal value means value of the cash flows at the end of the explicit period. So here our explicit period ends at year 2020. So implicit period start from 2021. So this 2021 is can be considered as the stepping stone year. So when we are determining the terminal value, we take that stepping stone year cash flow and then divide it by the required rate of return minus the growth rate. So required rate of return given in this question is 25% minus the growth rate is 7%. So the terminal value of this venture is equal to 232.36. So this is the terminal value. And then part 5, estimate the Softex equity value in rupees and per share at the end of year 2016. So that means we have to take the present value of all these cash flows. Right? So these are the cash flows for these years. Right? If we take the cash flows for 2017, it would be 2.9. For 2018, 10.4, and it comes to 20 you have to add the terminal value as well. And then we can determine the discounting factor. So the required rate of return here for equity holders is 25%. So divided by 1 plus 25%. We can fix that value since the discounting factor is not changing. And then multiply it by the number of years to discount. So let's here for 2017, if we are calculating the value at the end of 2016, we have to discount for 2 years. Likewise, now you can calculate the discounting factor and then the present value of these cash flows. So the equity value is equal to summation of all these values, which is 123.72. Let's say around round off to 2 decimal places, it would be 123.72. So this is the value of equity, and the per share value also we can calculate. Per share value, since we have done this calculation in thousands, the number of shares equal to 10,000. So you can divide this by 10. So the per share value is equal to 12.37 rupees. 12.37 rupees. Per share value. The equity, total equity value in thousands equal to 123.72. So the per share value is equal to 12.37 rupees. Right. So part 6 and 7 you all can attempt on your own. Right. Just you have to change in the part 6. You'll have to change the discounting factor. So instead of 25%, here you'll have to use 20%. So I will give the answers if you all want. You all can do and check the answers. So part 6. Part 6. The value of the business will be equal to 187.4. So therefore the per share value should be equal to 18.74. And if you take the part 7, if you take the part 7, the value of the business will equal to 153. 153.45. 153.45. 153.45. So thereby the per share value is equal to 15.3. So do the questions on your own and check whether you all are coming up with these values.